Hey everyone, welcome back to Corporate Decoder, the place where we break down the secrets hidden in plain sight, especially when companies try to pull a fast one with merger announcements. Get ready because today we're diving into a big announcement that could change a whole company. We've got Runway Growth Finance Corp making some major moves, and it's all about a merger. Stick around to understand what this really means for shareholders and the business. And before we get into the nitty-gritty, if you like getting these clear, no-nonsense breakdowns, make sure you're subscribed and ring that notification bell. We also have a fantastic Discord community where we discuss these findings further, all linked in the description below. Jump in and join the conversation. Alright, so what we're re-looking at here is a current report called a Form 8K. Think of it as the company S official bulletin board for really important news they have to share right away. And this news is pretty big. This report is all about Runway Growth Finance Corp, or R.W.A.Y. As you might see it, they're involved in some pretty serious business. And today's filing signals a major strategic shift. Let S quickly check out what is currently trading for R.W.A.Y. V got their common stock trading under the ticker R.W.A.Y on the Nasdaq Global Select Market. They also have some notes like the 7.50% notes due 2027 ticker R.W.A.Y and the 8.00% notes due 2027. Ticker R.W.A.Ys, it is good to know the different parts of the company that are out there in the market. The core of this filing is about a significant deal. We're talking about an agreement and plan of merger. Basically, R.W.A.Y is planning to merge with another company called S.W.K ING's corporation. The way it's set up is a bit like a multi-step dance R.W.A.Y will have its subsidiaries merge with and into S.W.K and then S.W.K, or its successor will merge upwards until R.W.A.Y is the final surviving company. It's designed to consolidate everything under the R.W. umbrella. Now, for the most interesting part for investors, what do the shareholders get out of this deal? When the merger goes through, the shareholders of S.W.K will have a choice. They can opt to receive shares of R.W.A.Ys, common stock, or they can choose to get cash. The amount of stock or cash they receive will depend on the net asset value, or NAV, of both companies calculated on a specific date just before the merger closes. This NAV is calculated using Generally Accepted Accounting Principles, or GAAP. This carefully figured out exchange ratio is key to making sure the deal is fair. Of course, big deals like this don't always go through. The agreement includes conditions under which either R.W.A. or S.W.K can walk away. A major one is that S.W.K's shareholders need to vote and approve this merger. If they don't, the deal is off. Both companies are making a bunch of promises and commitments to each other. These are standard in merger agreements. They're essentially agreeing to operate their businesses as usual before the merger, cooperate on paperwork, get necessary approvals, and pretty much do their best to make sure the deal happens. There are also restrictions on what they can do without the others okay, to keep things stable during this transition. To make sure everything is on the up and up, there are several conditions that must be met before the merger can be finalized. This includes getting regulatory approvals, like making sure a registration statement is effective, and that S.W.K shareholders give their green light. There are also those important checks on the company's health and financial standing to ensure no nasty surprises pop up. For example, S.W.K won't have to go through with the merger if a third-party valuation of their assets is significantly lower than their own book value. This is a safeguard for R.W.A.Y. Now, here is where it gets really interesting. To make sure this deal has a good chance of passing, R.W.A.Y also signed an agreement with a major shareholder of S.W.K, this key stockholder. Double Black Diamond Offshore Limited owns a substantial chunk of S.W.K shares, about 70%. Because they hold so much, they agreed to vote their shares in favour of the merger. This is a pretty powerful move to ensure shareholder approval. The agreement also puts some strict limits on what the key stockholder can do regarding R.W.A.Y itself, like trying to influence R.W.A.Y management or governance without R.W.A.Y permission. It is also worth noting that S.W.K's board took steps to make sure this merger doesn't run into certain legal roadblocks in Delaware, which is where S.W.K is incorporated. They made sure that the common provisions in Delaware corporate law that stop companies from engaging in certain business combinations won't apply here. This is another step to smooth the path for the merger. As is standard, the filing includes a section on forward-looking statements. This is basically the companies covering themselves legally, saying that any statements about the future are educated guesses, and that actual results could be very different. They list a whole bunch of things that could go wrong, like not being able to finish the merger on time, or at all, or potential lawsuits, or changes in laws. It's a reminder that mergers are complex and full of uncertainty. For anyone deeply interested, the companies are pointing to more documents they be filing, like a registration statement on Form N-14, which will include a proxy statement and prospectus. These will have even more details for shareholders of both companies. They're also directing people to the SEC's website and their own company websites to get these documents for free. This part of the filing identifies individuals who might be considered participants in persuading shareholders to vote for or against the merger. It's a disclosure requirement, letting everyone know who might be actively pushing their agenda in the shareholder vote. It lists directors and officers from both R.W.A.Y and S.W.K. And finally, to wrap up, we have the exhibits. This is where the actual full legal documents of the merger agreement and the key stockholder agreement are filed. These are the blueprints of the deal, so if you want the nitty-gritty legal language, this is where you'd find it. There is also a cover page interactive data file, which is useful for data aggregation. Now, looking at this whole situation, R.W.A.Y is making a bold move to acquire S.W.K. The rationale behind this is likely to achieve economies of scale, potentially reduce costs, and gain a larger market presence. The fact that they've secured agreement from a major S.W.K shareholder is a strong indicator that they're serious about getting this done and have a clear path to shareholder approval. However, mergers are always fraught with risk. The success hinges on effectively integrating the two companies and realizing the projected benefits without major disruption to operations or culture. A key risk is always the potential for shareholder litigation, which can be costly and time-consuming. Another point to watch is how the combined entity will manage its debt and cash flow, especially given the current economic climate. The core strategy here is growth through acquisition, but sustained profitability will depend on strong execution post-merger. Alright, that is our breakdown of this merger announcement from Runway Growth Finance Corp. What do you think about this big acquisition? Do you see it as a smart move or a risky gamble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more in-depth corporate analysis. Don't forget to join our Discord community, linked in the description, to continue the conversation. Thanks for watching, and I'll see you in the next one.